corporate valuation model has the pros and cons, right? So it's really difficult to understand because the procedure to get the final answer for the intrinsic value of the company is really bit complicated, but you need to know. So in this, so today we will talk about the corporate valuation model in more detail. Then finish up the chapter 10, the stock valuation, and then we will move to the chapter 9, bond valuation. So let's continue to figure out the corporate valuation model. As I told you, we will cover the detail, the issue about the valuation, corporate valuation model, but the what should you know is just the frame to the whole rough the procedure to get the final answer, which is the intrinsic value of the stock. Okay, so it's better understand whole procedure I will talk about, but it's okay to understand just basic frame to reach the final answer. Okay, so in last class we stop here. Okay, so to start the corporate valuation model, you need to know the free cash flow first, because the corporate valuation model we use the free cash flow. So first of all, you need to understand the free cash flow, definition of free cash flow first. So free cash flow is, as I told you, you can understand just the disposable cash flow that we use without any limitation. Okay. So the free cash flow, so I already introduced the equation to get the free cash flow. So free cash flow is the operating cash flow minus investment in operating capital. So you should think about the point of cash flow, cash, okay? Cash, not earning, not income, net profit, but cash. We need to focus on the cash, all right? So the operating cash flow can be calculated by EBIT times 1 minus T plus depreciation and amortization. EBIT times 1 minus T is called NOPAT, right? Net operating profit after tax. So generally to reach the net income, EBIT minus interest is gonna be EBT. If we pay the tax, that's gonna be net income, right? But from the point of the cash flow, we don't have to consider interest, because interest play a role as the financing cost, right? So financing cost can be reflected as the denominator to get the present value, right? So the financing, because the financing cost is used as a discount rate. So if we consider interest to get the to calculate the free cash flow, it's gonna be double count. Okay, so we don't have to think about the interest when we calculate the free cash flow, right? So we can deduct the tax directly from EBIT. So that's gonna be no PAT, net operating profit after tax. And then we need to add back to the the NOPAT to calculate the operating cash flow, because the depreciation and amortization are not associated with cash outflow, right? But to calculate the EBIT, we already deduct the depreciation and amortization. Okay, so from the point of the cash flow perspective, we need to add back the depreciation and amortization to NOPAT. all right? Because depreciation and amortization are not associated with cash outflow. So even if we recognize the depreciation and amortization as cost to calculate the EBIT, but in reality, depreciation, amortization, I mean the money, cash, do not flow out, right? So we need to add back. Okay, that's gonna be corporate operating cash flow. And we also consider some item that the flow out, cash out, right? So capital expenditure means what? If we buy some the fixed asset, just like building or machine, something like that, then we have the fixed asset, right? So instead of we have fixed asset, we should pay to buy the fixed asset. That's gonna be capital expenditure. So even if we spend some money, but that money is changed to asset, fixed asset. So from the point of the cash, this is the flow out. Okay, so this is the item to be deducted. Okay, so the negative. So we need to deduct as much as capital expenditure to calculate the free cash flow. And last one is more complicated one, net operating working capital. Let me explain net operating working capital more detail. Before net operating working capital, more original concept is net operating working capital. The more original concept is net working capital, NWC. Net working capital can be calculated by current asset minus current liability. 유동자산 minus 유동부채. That's it. Okay, that's the net working capital. But if we add net operating working capital, then we need to calculate more precisely. So we need to consider there are two components of current liability. One thing is the liability with interest. The other one is liability without interest. Okay. So for example, account payable. Account payable is recognized as the current liability, but we do not have to pay interest to the accounting payable, right? Accounting payable. So that things is the liability without interest. Okay. Whereas some the you know some the liability for some liability we need to pay the interest. Okay, the interest. So for example, note payable. For example, note payable. So if we issue some the short-term debt, then we need to pay interest, right? That's the note payable. So if we have the note payable, then we should pay the interest, right? The reason why I separated the liability with interest and liability without interest is because we need to talk about the net operating working capital. So this O, if we say this net operating working capital, we need to distinguish the liability with interest and the liability from the liability without interest, right? So there are two kinds of the liability. So net operating working capital is current asset minus not whole current liability, but current liability minus the this kind of things. The liability with interest. Only liability with interest. So interest, this one is what? Interest not bearing, I mean, how to say, interest bearing, not interest bearing, how to say, interest bearing. This is interest bearing liability. This is the not non-interest bearing liability. Okay, so the reason why we distinguish the liability with interest is because, as I told you, from the point of the cash flow, interest is already collected at discount rate, right? So if we consider this interest, then that's gonna be double count. So we need to, deduct those kind of the interest with, the liability with interest. Okay, so if we only think about the non-interest bearing liability as the current asset, that's gonna be net operating working capital. So net operating working capital, to calculate the net operating working capital, we need to separate the liability into liability with interest and liability without interest. And then we need to only consider non-interest bearing liability, which means the liability without interest. Okay, that's the net operating working capital. So if that net operating working capital is increased, means delta means increase, right? If that net operating working capital increase, means what? Current asset minus the non-bearing interest liabilities increase means cash flow out. For example, if we buy the raw material to produce production, raw material, then inventory is increased, right? Inventory is increased, but cash is decreased. Means we can buy raw material to pay as cash, right? So from the point of the cash flow, if we buy the raw material, then cash flow is decreased. Okay, cash flow is going to be decreased. So in this case, raw material is increased, so net operating working capital is increased, right? So the reason why we deduct the increase of that operating working capital is because that which is reflected to the flow out, right? Flow out. That's why we need to deduct as much as increase of net operating working capital, right? A little bit difficult to understand, right? So this is the equation to calculate the free cash flow, just like that. I will explain this one with the example, more detail in the later on. So this is the frame. So basically, in corporate valuation model, what we try to find out is not value of stockholders only, right? Not intrinsic value of stockholders only. So in dividend discount model, we started to calculate the intrinsic value with just what? Dividend, right? Dividend is related to only shareholders, right? Shareholders. But free cash flow is not only related to not shareholders, but bondholders, preferred common stockholders, preferred stockholders. There are three entities to related to the free cash flow. Okay, so by using free cash flow, we can calculate the value of entire firm, not value of just only stockholder, just like dividend discount model, right? So the object to calculate is different in dividend discount model and corporate valuation model. So in dividend discount model, we only consider dividend that is related to the only stockholders, okay? But in the corporate valuation model, we need to calculate the value of a whole company first. As the market value of the firm, the finding of present value of firm's future free cash flow, and then subtract the market value of firm's debt and preferred stock to get the market value of common stock. That's mean that's the dividend discount model. In dividend discount model, we can calculate the intrinsic value of the stock, but in the corporate valuation model, first of all, we calculate value of entire firm. Okay, this is common stockholders. The stakeholder of this value are three entities: common stockholders, bondholders, preferred stockholders. Okay, so to calculate the intrinsic value of the stock, this amount, right? Then we need to subtract the bondholders value and preferred stockholders value out of total entire firm value, right? So we need to subtract the market value of the debt and preferred stock to get the market value of common stock from entire firm value. All right. So starting point is different. In dividend discount model, just we only consider the stockholders value, whereas in corporate valuation model, we calculate the value of entire firm first, and then we need to subtract the value of the bond and the value of preferred stock to get market value of common stockholders, right? And then divide market value of common stock by number of shares outstanding to get intrinsic value per share. This procedure to calculate per share. So the procedure we have talked about is all whole value of the entire firm, right? Not per value basis. So after after subtracting the debt value and preferred stock value, then we need to divide it by number of shares, right? So, and this is uh, the pros of the corporate valuation model. What the advantage is the corporate valuation model. Okay, so often prefer to the dividend growth model because especially when considering number of firms that don't pay dividend or when dividend are hard to forecast. So as we talked about, figure out in the first class, we cannot use the dividend discount model if the company do not provide a dividend. That is not good again. Okay, so as I told you, right? So we cannot use the dividend discount model if the company do not provide a dividend. So in that case, we can use the corporate valuation model, or when dividends are hard to forecast. So as I told you, it's very hard to forecast the dividend in the future, right? Even if the corporate valuation model is also forecast the future free cash flow, okay? But I'm not sure to forecast the future cash flow is a little bit easier than the forecast of the dividend, right? And the second one is but the logic is just identical to figure out the intrinsic value by using the dividend discount model. So similar to dividend discount model assumes at some point free cash flow will grow at a constant rate. So we figured out the free cash flow in the near future, the last year, 2 years later, 3 years later, 4 years later. And then just like that, the constant dividend discount model, we assume that the free cash flow grow at a constant rate after some specific time, right? Then we can calculate the terminal value, right? As we know. So basic logic to calculate the free cash flow is just same identical as the dividend discount model, right? So in the near future free cash flow, we can forecast directly, and we can calculate the terminal value after some specific period. Okay, so terminal value, as you know, can be defined as the total amount free cash flow after some specific period, right? That's the terminal value, right? So here is so terminal value represents value of firm at the point that growth becomes constant. So here's the example. The same thing, right? With the dividend discount model. So let me give you example here. So given the long run growth rate for free cash flow, not dividend, right? Not dividend, but free cash flow. So we assume the free cash flow grow at a constant rate as much as 6% after 3 years. After 3 years. And we can calculate the free cash flow in the near future. So future cash flow may be negative in first year, at the end of first year. At the end of second year, we forecast the free cash flow of 10. The unit is $1,000,000, I think, $1,000,000. And third year, at the end of third year, we forecast the $20,000,000 of free cash flow. And then we assume that free cash flow grow at 6%, right? 6%. Then this is terminal value, right? Terminal value. So 21.2 can be calculated by what? 20 times 1.06, right? So if dividend or free cash flow grow at a constant rate, then we can use dividend discount model, right? So that's gonna be P0 equal to D1 divided by RS minus G, as you know. But the terminal value, then the time as of not today, as of year 3, P3 equal to D4 divided by RS minus G. But now we are calculating what? Not dividend, terminal value of dividend, but terminal value of free cash flow, right? So P3 equal to free cash flow at year 4 divided by minus G, something minus G. Something is not RS, okay? Not RS. So we will talk about this issue in chapter 11, cost of capital. So there are three resources, right? One of them is common stock. The other one is preferred stock. Third one is bond. We would say the investor, I don't know, the company and investor. From the point of investor, this is the required rate of return or required rate of return on common stock. This is from the point of investor, this is the required rate of return on debt or yield. Debt yield. So in terms of bond, we used to use the terminology of yield. Yield, so yield to maturity, as you know, right? Yield to maturity. So instead of return, we used to use the terminology of yield for the debt. Okay. So, no, this is bond. Sorry about that. This is preferred stock, for example. Okay. Then, if we invest our money in preferred stock, that's the return is preferred stock return. Preferred stock return. Okay? From the point of investor. This one, from the point of company, this one is what? Cost of equity, common equity. This one is cost of debt. This one is cost of preferred stock, well, preferred equity. Okay, so we will talk about later on in chapter 11. WACC is a weighted average cost of capital. From the point of the company, this is the weighted average cost of capital. If we consider not only common stock, but also whole possible resources to raise a fund. This is the WACC, weighted average cost of capital. 우와! 우와! 예, WACC, 우와! 예, WACC, 우와! 예. So weighted average cost of capital. 우와! 예, 우와! Okay? So when we use the dividend discount model, we use this one, right? Because we only think about the common stock. But in the corporate valuation model, we calculate the entire value first, right? So instead of using this only cost of equity, but we should use WACC because we, think about all of we calculate the whole value of entire form, right? So instead of RS, we should use WACC in corporate valuation model. This is the most different thing in the comparing to the dividend discount model, right? So denominator is not RS, denominator is not RS, but what? WACC. Okay, so P3 can be calculated by free cash flow at time 4 divided by not G, but WACC minus free cash flow growth rate. Right? So free cash flow at time 4 is expected to 21.2 because the $20 times 1.06, right? And WACC is already given. So for instance, in the exam, I may provide the information of WACC or RS simultaneously. Then you should pick WACC, not RS, to calculate the intrinsic value by using a corporate valuation model. And the growth rate is assumed to be 6%, right? All information are given. Then this is the $530 million. This $530 million means all of the free cash flow happened year 3, as of year 3. This is the 530. This is the terminal value, right? Then the last step is what? We need to calculate the present value of each free cash flow, right? So negative 4.541 can be calculated by negative 5 divided by 1.1 WACC. The WACC can be used as also the discount rate. It's gonna be that one. 8.264 can be calculated by 10 divided by 1.1 square. 15.026 can be calculated by 20 divided by 1.1 to the power of 3. 398.197 is 530 divided by 1.1 to the power of 3, right? Don't be confused of 3, okay? So, and if we sum up all kind of the present value of each free cash flow that happened in the first year, second year, third year, and then forever, it's gonna be $416.942. This is the total value of entire firm. then we should do some next step, right? So as I told you, this is not whole value of only common stockholders, but including the preferred stockholders and the bondholders value, right? So we need to subtract those kind of value from the entire value. So here is the information about next step. If the firm has $40 million in debt and there's no preferred stock, so we don't have to think about the preferred stockholders value, only think about the debt holders value, bondholders value. So if we assume the $40 million in debt and has the 10 million shares of stock, then what's the firm's intrinsic value per share? Then market value of equity, total entire one is the 416.94, and the market value of debt is 10% out of this one. This is the $40 million. So the remaining one is for the common stockholders, right? Common stockholders is $376.94 million, right? Then the last step is what? We need to divide by number of shares to get the per share, stock price per share, stock price per share. So this is $376.94 divided by 10 million number of shares is going to be $37.69. The end. So the intrinsic value of the, this company is the $37.69 per share. All right. Okay. Then let's take a look at the example in textbook. If you take a look at the page number 383, table 10.2, 383, this one. But in Excel spreadsheet is the forecasted years from 2013 to 2017. But in the textbook is the add 3 more years. So according to the textbook, the forecasted year started from 2016 to 2020. So according to the textbook, we are at the end of 2015. In this Excel, we are in end of 2012. Okay, so we forecast the 5 years free cash flow, and we assume that this free cash flow grow at 6% constant, right? Constantly 6%, and the WACC is assumed to be 10%. Then this table provide the information how can we get the free cash flow, right? So let me explain roughly, go through very quickly. So you don't have to know what I will explain step by step, but as I told you, you need to know the frame to get the final answer. Okay, so you don't worry about if you do not understand what I'm talking about, then it's okay. Okay, even if I will explain very quickly. So this is, for example, 2013, 2016 in textbook, 2013 Excel spreadsheet. So let's say sale is 3,300. Operating cost is this one. Depreciation is 116, for example. Then EBIT can be calculated by sales minus operating cost minus depreciation. So depreciation can be used as the deduction item, right, to get the EBIT because this is the cost. Definitely, this is cost based on the accounting, okay? But based on finance, this is not cost because why? Even if we recognize the depreciation as cost, But from the point of the cash flow, that amount do not flow out, right? Do not go out, right? So, the taxes we need to pay tax. So we need to add back to the EBIT times 1 minus T because from the point of the cash flow because this 116.6 not associated with cash outflow, right? So even if we recognize the 116.6 as depreciation, as cost to calculate the net income in accounting, but 116.6 did not flow out, right? So still we have the cash, right? So we need to add back. So this is the EBIT row 154. Present this is the NOPAT, right? NOPAT net operating profit after tax, not NOPAT. I have two pets. No, yeah, NOPAT. Yeah. Two dogs. Yeah, very smart, smarter than me. Smarter than me, right? One of them is the mix of the border collie. Border collie is so smart. Border collie is the the how to say the around the sheep, right? Yeah, the border collie, border collie, border 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 collie, border collie, border collie, border collie. That guy is very smart, smarter than me. It's true. Yeah. Okay. Anyway, yeah. So no pet, no pet. Yeah, no pet. Yeah. Net operating profit after tax. So the row 154 is no pet. Represent no pet. So no pet plus depreciation. This is what operating cash flow, right? Operating cash flow. We, as you know, right? Have operating cash flow. This is operating cash flow, right? Operating cash flow. This is operating cash flow, right? Operating cash flow. Oops. Then, this is operating cash flow, right? And the net fixed asset is 1,080, for example. Net operating capital is 864, but last year is $800. So in terms of net operating capital, we need to calculate the increasing amount or decreasing amount, right? So this net operating capital increased to 864 from 800. So we need to consider only 64. 64 can be calculated by the net operating capital this year minus net operating capital last year. Okay, so as much as increase net operating working capital, our cash flow out, right? So this is the deduction item. So the capex and delta net working capital. So the free cash flow now, free cash flow can be calculated by the operating cash flow of 304.1 minus capex, capital expenditure. Capex stands for capital expenditure, and delta net operating capital is gonna be $43.4. Okay, if you repeat this procedure, then during the next 5 years, and then we assume that what free cash flow grow at a constant rate as much as 6% from 2017 in 2020 in textbook. Okay, then this is the procedure to calculate the terminal value. So the free cash flow 2012 or 2012 one in textbook can be calculated by 108.4 times 1.06 because growth rate of free cash flow is 6%. Okay, and the horizon value can be calculated by free cash flow 2018 divided by AACC minus the growth rate of the free cash flow is going to be 2,820 $72.2. Okay, so this one should be discounted by 1.1 to the power of 1, 2, 3, 4, 5, right? That's gonna be $1,783.7. So if we sum up the present value of free cash flow from 2013 to 2017 is gonna be $244.1, $45.1, and present value of terminal value as of 2017, 2020 in the textbook is gonna be $1,783.7. The total value, total corporate value is about $2,000, and we assume that market value of that is $806. So if we subtract the $806 from the $2,028.8, it's gonna be $1,168.8 for common stockholders. Then if we assume the number of shares outstanding is 50 million, then $23.38 is per share can be calculated by 1168.8 divided by 60. That's it. Okay, yeah, that's I explained the whole procedure to get the final answer, which is the stock price per share. Go very quickly go through. All right. So now if we write down, so yeah, you don't have to, we don't have to write down again, right? In the textbook, table 10.2. So the important thing is what? Free cash flow in textbook, we figured out free cash flow 2016, 2017, 18, 19, 20, blah, 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 blah. 2020, the cash flow is 108.4, right? This is free cash flow. So free cash flow 2012 1 can be calculated by 108.4 times 1.06 because it's the growth rate. It's gonna be $114.9. Okay? So terminal value of 2020, terminal value 2020 means 2021, 2022, 2023, 2024, all kind of the value, sum of all kind of value as of 2020, right? This is the free cash flow 2021 divided by WACC minus G. So FCF 2021 is 114.9, and the WACC is what percent? Junso, Juneso. Yeah, WACC is
10%.
10%, right? 10%. Growth rate is 6%, right?
6%.
So if we calculate this one, then it's gonna be 2,872.7. So this is the 2,872.7. So this is the free cash flow 16, free cash flow 17, 18, 19, 20, terminal value 2020. Okay. Then we need to calculate the present value, right? 1, 2, 3, 4, 5, 6, including the terminal value. Then sum of the all kind of things is the $2,028.8. And we assume the bond is 860 to 8.8, 8.60 is gonna be $1,168.8 divided by number of shares. It's gonna be $23.38. Okay, that's the table 10.2. All right. So any question about the table 10.2? So as I told you, you better understand what I'm talking about, all of things, but it's okay to understand just the frame. So you don't have to know the detailed procedure to get the free cash flow. But after free cash flow, I mean, the getting free cash flow procedure, you need to know, right? So once we calculate the free cash flow, then we need to calculate the present value of free cash flow, and then we need to deduct the market value or preferred stock. I mean, the market value of the bond or preferred stock to get the market value of the common stockholders, and then we need to divide by the number of shares, okay, to get the per share value, right? The intrinsic value. That's the corporate valuation model, right? So, any question about this procedure? Right. And next topic is the last one is preferred stock. So far, we talked about the common stockholder value, common stock value. So the preferred stock. 꺼졌어 왜? 송태진이 어디 갔어? 태진 안 보여? I cannot see you. Your 어디 갔어? 마크는 어디 갔어? 마크 하나고 어디 갔지? 마크 하나고 어디 갔네? 마크 하나고 마크 체크 왔네. 오케이. He's coming. Okay, the last topic is preferred stock. So similar to bond in some 태진이 어디 갔어? 태진 아나와 very famous the singer in here in Korea. 미안해 미안.
혹시
Okay.
들리시나요?
예, 어디 갔어요?
제 노트북이 고장났다 지금 수리 맡기고 집 가는 중이어서 반대로 바로 캠 켜도 될까요?
예, 근데 태진아 알아요?
네.
태진아 노래 하나 해봐. 야, 농담입니다.
감사합니다.
SK. 야. 미안. 야, 오케이. 야, 프리버스. All right, so similar to bond in some respect and to common stock in orders, right? So preferred stock has two kind of characteristics. One of them is the bond, the other one is the common stock. So like bond, preferred stockholders receive the fixed dividend that must be paid before dividend are paid to common stockholders. So preferred stockholders receive the fixed dividend, not variable dividend. Okay. So this fixed dividend is sort of similar to the interest to bondholders, right? Interest. So the fact that preferred stockholders receive the fixed dividend is the very similar characteristic of bondholders, right? That must be paid before dividend are paid to common stockholders. So why the name is preferred? Preferred to what? Preferred stockholders have the right to receive the dividend prior to common stockholders. Okay, so preferred dividend, preferred. So that's why the name is preferred stock, preferred to dividend, right? Preferred to dividend. So even if the preferred stockholders receive the dividend prior to the common stockholders, but preferred stockholders do not have any voting right, as I told you. But before dividend are paid to common stockholders. So if the company generate do not generate the profit, okay, then the company cannot provide a dividend to the common stockholders, right? In that case, the company may do not provide dividend to the preferred stockholders is okay. Okay, but if the profit is recovered, so the company want to provide the dividend to the common stockholders, then company provide the dividend to the preferred stockholders first that do not provide yet the last year 2 years later. Okay, so to provide the dividend to the common stockholders, the companies should give the dividend that did not provide last year and 2 years later to the preferred stockholders first. Okay, so that's the preferred stock. Okay, so that is the fixed dividend is same as the meaning of the bond because it's a fixed amount. However, companies can omit the preferred dividend payout without fear of pushing the firm into bankruptcy. So, if companies do not provide the interest to the bondholders, that is one factor to be bankrupt, right? So if the company cannot provide interest to the bondholders, that's gonna be bankrupt. But if it's okay, even if the company do not provide a dividend to the preferred stockholders, that's not requirement, right? So that is sort of the stock's characteristics, not bond characteristics. So if preferred stock has just bond, then if the company do not provide a dividend, that's gonna be the factor to be bankrupt, but it is not, right? It's not. So companies can omit the preferred dividend payments without fear of pushing firm into bankruptcy. That's what I told. Okay. That's the preferred stock. But yeah, but it's not necessarily so. We will talk about that one in the next the bond issue. There's the name of income bond. So I told you if the company do not provide interest to the bondholders, it's gonna be bankrupt, right? Except there's except income bond. In income bond, it's okay, even if the company does not provide interest to the bondholders. Only one exception. Income bond means the coupon interest is determined depending on performance of the company, performance of income. So positively related to the income. So even if this is bond, but the interest is not fixed, but changed depending on performance, depending on income. So that's why the name is the income bond. So in income bond, it's okay. The company do not provide a dividend. So it is not necessarily that even if it is not necessarily that if companies do not provide a dividend, it should be bankrupt. No, there is one exception, income bond, right? Now, how can we calculate this bond preferred stock? So here we go. If preferred stock with an annual dividend of $5 sell for $50, what is the preferred stock's expected return? Okay, so we already figured out the preferred stock. The value is if we use the dividend discount model, P0 equal to D1 divided by RS minus G, right? But if the dividend is constant, that's gonna be the way to calculate the preferred stockholders value, preferred stock value, right? So D1 equal to D0, G equal to 0. So this is a D0 divided by RS. We talked about, right? We figured out. Mark 또 어디 갔다? Mark. Where are you going, Mark? Mark 하고 가야지. After you mark something and then come back. Yeah, okay. Yeah. So when you figured out the price, I mean the intrinsic value of the stock, if the dividend is constant, then we figured out this one, right? But in more exact terms, not RS, as I explained the first part of this class, the zero divided by what? RP, preferred stockholder. So RS is very close to the RP, but not exactly same, right? So RS is very close to the RP, but as you shall see in the chapter 11, but it's not exactly that equal. So, but preferred stock price can be calculated by dividend, preferred stock dividend divided by the required return of the preferred stock. Required return of preferred stock is equal to cost of preferred stock, right? So, but so we if we have the this is three number of variables, right? 1, 2, 3. So if we know 2 out of 3, then we can calculate the remaining one. So, but in this example, we have the information of the dividend $5 and the stock price, preferred stock price is $50. Then we can calculate the expected return of preferred stock, right? We know this one and this one, then we need to calculate this one. RP is the expected return of preferred stock as well as cost of preferred stock, right? The same thing, the cost of preferred stock. So in this example, RP equal to, if we change the mutually, then DP divided by PP, right? So DP is the, how much is that? Dividend, $5, price, $50. Then the expected return is 10%. Okay, that's it. Any question about chapter 9 stock? All right. If you don't have any question, let's go back. Go to the bond. All right, bond and their valuation. In this chapter, we will talk about the key features of bond, bond valuation, and measuring yield and assessing risk. So this chapter 10, 9 is very related to chapter 7, interest rate. So if you understand the interest rate completely, then it's very easy to understand in the chapter contents in chapter 9, bond. So bond is all about interest, right? So, but if we dig more, then it's very complicated bond. So you very mathematics oriented chapter. So we have the fixed income security class course, fixed income course we open, right? So during the one semester, we study just bond, whole of the semester. Okay, that's a fixed income. It's very complicated, but rather than stop, if you are familiar with bond, then it's better to get a job in the financial industry. Okay, so all of the guys are interested in bond, the stock. So instead of a stock, if you are good at bond or derivatives, and the opportunity to get a job in financial field, financial industry, it goes up. Okay, but the derivatives as well as the bond demand the complicated math demand, right? So anyway, but we will talk about just only one with only one chapter, right? So at financial management level, I will give you very basic fundamental concept or knowledge, right? Okay, what is bond? Long-term debt instrument in which a borrower agrees to make payments of principal and interest on specific dates to the holders of the bond, right? It's very simple structure. So there's the borrower and lender. Borrower is company, lender is the investor, right? So two entity make arrangement. Okay, I will give the interest a specific day, first day, 1 year later, 2 years later, 3 years later. Sometimes, coupon. This is called a coupon. Interest is a coupon, right? Interest is coupon. So, two entity make arrangement. Okay, give me the coupon as interest. First year, at the first year, second year, third year, and then I will give the 원금 principal, right? So from the point of the borrower company, they should pay interest on specific day, arrange the specific day, and then they should repay the principal at the maturity. This is the maturity, right? Whereas the investor can be received interest at the specific date, and then the investor can receive the principal at the maturity. That's the bond, right? Bond. But some bond, the corporate bond, some company provide the dividend, not dividend, provide the interest twice a year, or 4 times a year on every quarter. Okay, so generally the corporate bond in US provide 2 times a year as coupon. Here in Korea, 4 times. So for example, coupon rate is 4%, then we will receive the 1% on every quarter. Okay, in the US, 2%. I received 2% coupon on the end of June, and 2% I received 2% coupon on at the end of December. Not every June at December. If the company issue the July and April, then I can receive the March the coupon, or September, just like that. Okay, so 6 months, on every 6 months or on every quarter, just like that. So here is the key features of bond. Par value, or as the face value. Par value is also named as face value. Par value is face amount of bond which is paid at maturity. And from now on, we assume the face value is $1,000. And coupon interest rate is stated interest rate, generally fixed, paid by the issuer, multiplied by par value to get dollar in payment of interest. Coupon interest rate, and the maturity date is years until the bond must be repaid. In previous example, 3 years maturity, so something like that. Issue date when the bond was issued. Yield to maturity, you've heard about it, right? Yield to maturity is rate of return on a bond held until maturity, also called the promised yield. So don't be confused of coupon interest rate and yield to maturity. Real return on bond, real return in bond, real return is not coupon interest rate, but yield to maturity. Okay, don't be confused of. if you do not take the financial management, then most of guys think the return on bond is coupon interest rate, the force, right? That's wrong. So by the same as the stock. So we talked about stock has two resources to return, right? One of them is capital gain yield. The other one is dividend yield. I already explained that one, right? So we can enjoy, if the stock price goes up, we can enjoy the capital gain yield, as well as if the company, the company that issue the stock, that provide a dividend, that we can have the additional cash, right? And the return, the dividend yield. Same as stock, bond has also capital gain yield plus dividend, not dividend yield. This is the coupon. This is the coupon interest rate, coupon. So coupon is one of the return, right? Some part of return. But if capital gain yield is minus, then coupon is the higher than the real return, right? So in bond, we also enjoy capital gain yield. I will explain later on. Real return on bond is not coupon, but yield to maturity. This is yield to maturity, right? Yield to maturity, as you shall see, right? Okay, so bond has a lot of the provision. We can attach a lot of the provision to the bond. So if we would say bond without any provision is called as vanilla bond. Vanilla bond or plain bond. Vanilla bond or plain bond. If we attach some of the provision, then there's various the type of the provision can be attached to a bond. So callable bond, puttable bond. Callable bond is if the call provision attached to bond is called as callable bond. If the put provision is attached to bond, is puttable bond. If the convertible bond means the current feature is bond, but that is gonna be changed to the stock, something like that. All of things is the other types of bond, right? So let's take a look at the callable bond and puttable bond. Callable bond is to give the issuer the right to redeem the bond prior to maturity, whereas the puttable bond to allow the holder to sell the bond back to the company prior to maturity. Okay, so originally, the bond cannot be redeemed before the maturity. Okay, originally we can make arrangement, right? Then I will please give me the interest on every year, and please give me the principal at maturity. That's the original contract, right? Or from the point of the borrower, okay, I will give the interest on every specified date, and I will give the principal at maturity, which is the original contract between borrower and lender. But if callable provision is attached or puttable provision is attached to bond, then we can redeem the bond before the maturity. Redeem means what? We can receive the principal before the maturity. We can give the principal before the maturity. Then, depending on who has those kind of right. Okay, so callable bond is the provide those kind of right to the issuer. Puttable bond is those kind of the right to the bondholders. That's the opposite way, right? Opposite way. Then when callable bond is issued, when puttable bond is issued, callable bond is first. If interest expect to decrease, okay, so let's say from the point of the company, the borrower, okay, it is not necessarily market interest rate. It's not equal to coupon rate, right? Not equal, right? But the direction is same thing, right? Direction is if market interest goes up, then coupon interest goes up. Market interest goes down, coupon interest goes down. So the direction of movement is identical, okay, but not exact figure, same figure. So for example, current market interest rate is 3%, coupon interest rate is 4%, for example. Then I expect the market interest rate is decrease. I'm the company, okay, the issuer, right? Then I already issued a 3 years maturity bond. First year, second year, 3 years. So I should pay 3% and 4% for bond, right? As interest. But if interest goes down, market interest goes down 3% to 2%, for example, then our coupon rate are more likely to decrease from 4% and 3%. Okay, then I already issue the bond with 4% of coupon. Then it's loss from the point of the company, right? If the company redeem this bond A at year 1, and then the company issue the bond B with 3% of coupon rate, then it's benefit to the issuer. Okay, so if interest rate is expected to decrease, then the company are willing to attach those kind of right to the bond, which means I can pay the principal before the maturity to reduce coupon interest, to reduce cost. That's called as callable bond. Call provision is callable bond. Callable bond. Then who is the advantage? Who is the advantage? Issuer or the investor? Issuer, company or investor? Who is advantage in callable bond? Definitely, company has the advantage than the investor. Then from the point of investor, there is no way to buy those kind of bond, right? If this bond coupon rate is same as the plain bond, investor are not willing to buy those kind of bond. So how come? So that's why callable bond coupon rate is higher than plain bond. Otherwise, the bond cannot be sold, right? So callable bond, coupon rate of callable bond is higher than the coupon rate of plain bond, right? Otherwise, the bond is not sold. Other things constant. Callable bond coupon is higher than plain bond coupon. Okay? On opposite way, putable bond is what? Bond holder has the right to redeem the bond when if rate expect to increase. Okay, so this is a different opposite way. So current coupon is 4%, but the market return is 3%, but market interest expect to increase from 3 to 4, then the coupon interest is expected to increase 4 to 5. Then from the point of the investor, my existing bond only provide 4% coupon, but current, if I buy the bond, in this market, I can enjoy 5% of return. Then I'm willing to redeem. I'm willing to receive the principal before the maturity. So if interest rate is expected to increase, putable bond can be issued. Then who is the advantage? Bond holders or issuer? definitely bond holders has the advantage, right? So putable bond coupon interest rate is lower than plain bond. Otherwise, who issue those kind of putable bond? Okay, so callable bond and putable bond has the, opposite way. It's located in the opposite way. And callable bond, the, benefit entity for the callable bond is the, the issuer. Putable benefit for the putable bond is the, the bond holders, right? So, coupon rate of callable bond is higher than plain bond. Coupon rate in the putable bond is lower than plain bond, right? So we talked about callable and putable bond, and next class we will talk about another provisions such as CBBW, something like that, and then we will figure out the valuation of bond. Okay. Oh, 3 minutes passed. Any question?